Joining us now in a CNBC exclusive is Synovus CEO Blair. Kevin, welcome back. Good to see you.
Thank you, Sarah. It's great to be back with you.
First thing is everyone looks at deposits with some of these numbers on the big and small banks alike, and it does look like you continue to see stabilization there. So is the worst behind you as far as some of that panic selling, panic moving money out of deposits?
Well, yeah, I think from a solvency standpoint, in terms of just being able to maintain and grow deposits, I think that storyline's kind of past us. And we're moving on to a storyline on what is the cost of deposits as you look to grow. And as you suggested on the lead in, one of the things that we've done at Synovus is to make sure that if we're lending money to clients that have a full relationship with us and that we're getting the proper returns. As the cost of liquidity increases, it just puts a demand on the bank to be smarter at how we deploy our capital and ultimately to make sure that we're getting a good return for the use of that capital.
Looks like you did lower the outlook for loan growth. Why is that? What are you seeing?
Well, two things. Number one, as we've talked about in the past, with the economic slowdown, there's just lower demand from our clients. And two, for us, we made the decision during the second quarter to sell a portfolio of medical office buildings, which represented about $1.3 billion in outstandings. And we did that. It's a pristine credit quality portfolio. But when we look at the environment today and we think about the returns that we have to earn on our capital, and you think about the constraints around liquidity, it had a high single-digit return on equity. And one of the things that we want to maintain through this environment is stronger returns. And so when we have the opportunity to optimize the balance sheet by reducing lower returning loans, and then take that capital and liquidity and redeploy it into asset classes and loans that give us a higher return and ultimately can be more scalable and expandable from a client standpoint.
Kevin, talk a bit about the credit quality trends you're seeing. You did have net charge-offs a little bit higher than expected and non-performing loans as well. Is that something that you expect to continue? How would you characterize the environment there?
Yeah, Mike, we use the word normalization because we're coming off historically low levels for NPLs and charge-offs. So as we think about the full year of 2023, we're expecting charge-offs to be between 25 and 30 basis points, which is where we expect it. Now, the second half of the year, we expect charge-offs to be up over the first half, but we'll still come in line with where our original expectations were. In this sort of environment, when you continue to see a slowing of the economy, you're going to continue to have some drift in credit. And we've tried to foreshadow that by noting that we expected that. So this quarter was really more in our expectations. And as we look at it going forward, we don't expect there to be a great deviation from what you've seen this quarter. Slightly higher NPLs, slightly higher net charge-offs, but we fully reserve for those, and we don't expect them to get out of the range that we've seen this quarter.
One of the marks on earnings was that your decision to sell this $1.3 billion medical office loan portfolio. So can you talk a little bit about why you made that decision and what your overall goals are here when it comes to commercial real estate?
Well, it's really balance sheet optimization, and we're looking at it both from a business mix perspective, but really it's about returns and optimizing our returns. And when you look at the $50 billion of loans that we have on our balance sheet, we want to make sure that we're getting an adequate return on the capital that we're deploying. And so we, during times like this where you have to go back and look at the liquidity costs, you go back and you find asset classes or individual loans that you don't feel are giving you the return that you require. And in this particular decision, we made the decision to sell this portfolio at a very small loss. So it shows you that it was a pristine credit portfolio. And now we can take that $1.3 billion, pay down wholesale funding, or redistribute it to clients and asset classes that are going to give us a higher return. I just think that's what you're going to see banks doing in the near future, is trying to optimize the balance sheet, trying to optimize their business mix to improve returns when the interest rate environment continues to put pressure on the margin.